Hey everyone, welcome back to the channel. Today we're talking about one of my favorite strategies for building real long-term wealth. Finding companies that don't just pay you to own them, but give you a raise every single year. I'm talking about dividend growth stocks. If you're building a portfolio for the long haul, these are incredibly powerful investments to hold. Now, what are they exactly? These are companies that not only pay out a portion of their profits to shareholders, that's the dividend, but they also regularly increase that payout year after year after year. This isn't just a nice little bonus. It can be a great indicator of a company's health. It shows that the management team is disciplined, financially strong, and super confident about their future earnings. In some cases, however, companies can simply end up raising their dividend payments for the sake of keeping their streaks going. So it's always important to analyze these stocks and not simply assume that their dividend payments are going to be rising forever or that they're safe. But for dividend growth stocks that are indeed safe, that rising stream of income ensures inflation isn't chipping away at that dividend income over time. And if you reinvest those payments back into the stock, you can dramatically accelerate the power of your compounding. Your investment starts getting bigger and bigger. Often, these kinds of stocks are mature, stable businesses that provide essential services, things that we can't live without. This makes them fantastic defensive players in your portfolio, especially when the market gets choppy and volatile. Today, I'm going to be looking at two of the most impressive dividend growth stocks on the entire stock exchange. These are two Canadian utility giants that have been rewarding their shareholders for over half a century. They're the only stocks on the TSX with dividend growth streaks of more than 50 years. First up, we have Fortis. Fortis is pretty much the poster child for a low-risk, high-quality investment. This is a regulated utility company, which is a fancy way of saying they provide essential services like electricity and natural gas that people and businesses need no matter what the economy is doing. This creates an incredibly predictable and stable river of cash flow for the company. And the proof of its reliability is in its numbers. Fortis has an absolutely remarkable track record. It has increased its dividend for 51 consecutive years. For over half a century, through recessions, market crashes, and global crisis, Fortis has consistently given its shareholders a raise. Very few companies can claim that. Meanwhile, it's already offering a fairly good yield today at 3.4%. By comparison, the average stock on the S&P 500 yields around 1.2% right now. But Fortis isn't just a boring, stable company coasting on its reputation. It has a real growth story. The company is in the middle of a massive $26 billion 5-year capital plan. It's investing heavily into infrastructure to modernize and expand it, and management expects this to fuel an annual growth rate of about 6.5% all the way through to 2029. And the company's growth has led to generous rate increases for the dividend. Since 2020, its dividend has jumped by 29%. That averages out to a compounded annual growth rate of over 5%. Fortis isn't just barely increasing its dividend, they're delivering meaningful raises for shareholders. Even better, they're doing it safely. Their payout ratio is a modest 72%. Now, what does that mean? It means that for every dollar they earn, they're only paying out 72 cents in dividends. That leaves them with a healthy cushion to reinvest in the business, handle any unexpected costs, and most importantly, continue increasing that dividend in the future. In fact, another increase is likely to be announced very soon. To top it all off, the stock has had a great year thus far, climbing by more than 20%, and it has an exceptionally low beta of just 0.35. Beta measures a stock's volatility compared to the overall market. A beta of 1 means it moves with the market. A beta of 0.35 means this stock is incredibly stable and tends to stay much calmer when the rest of the market is going wild. It's a fantastic option for preserving your capital. So that's Fortis, a 51-year streak, solid growth, and a very safe dividend. Now let's turn to its competitor, Canadian Utilities. If you thought 51 years was impressive, get ready for this. Canadian Utilities holds the record for the longest streak of dividend increases of any publicly traded company in Canada. They have raised their dividend for 53 consecutive years. This unmatched history makes them a true dividend king and a top-of-mind choice for investors who are looking for a high current income stream. Right now, their dividend yield is very attractive at 4.6%. And just like Fortis, it's a defensive stock. Its beta is also low at 0.57, meaning it's significantly less volatile than the broader market. But, and this is a big but, when you look under the hood, some concerns start to pop up. First, let's talk about the pace of that dividend growth. While the streak is long, the raises have gotten tiny. The company's current dividend is only 5% higher than it was back in 2020. That works out to a compounded annual growth rate of just 1%. At that rate, your dividend income isn't even keeping up with the rate of inflation. It feels a lot like the company is raising its payout by the bare minimum needed just to keep that 53-year streak alive. But here's the more pressing concern, its payout ratio. Remember how Fortis was paying out 72% of its earnings? Well, Canadian Utilities' payout ratio is currently over 100%. The company is paying out more money in dividends than it's actually earning in profit. It's simply not sustainable in the long run without a significant improvement in earnings. This raises some serious questions about the long-term safety of the dividend, even with its incredible history. So that brings us to the final question. Which dividend stock is the better buy today? While both of these companies are excellent choices for stable long-term income, I think the evidence points to a clear winner right now. For me, Fortis appears to be the superior option. Its strong and most importantly sustainable dividend growth is backed by a clear multi-billion-dollar investment plan for the future. Its healthy payout ratio gives you confidence that those annual raises will continue for years to come. While Canadian Utilities has the longer streak and has a higher starting yield, its stalled growth and strained payout ratio are significant red flags for long-term investors. So if you're a retiree looking for a reliable income or any investor focused on building wealth through dividends, Fortis offers a much more compelling combination of safety, income, and real future growth potential. But what do you guys think? Do you own either one of these stocks? And which one would you choose today? Let me know down in the comments. As always, thank you so much for watching. If you got any value of this video, please hit that like button and consider subscribing for more content just like this. See you in the next one.